Hi, you're watching Investor Insights. It's 4:30, Tuesday morning, 27th of August. The trade this morning has been rather very tepid. The S&P and the Dow are barely 1/10 of a percentage point higher. All the currencies against the US dollar have barely moved. And I can say that because of that, I'm going to shoot the update before the close, because I've been up 22 hours, so I think it's time for some rest. We've got a multitude of articles today to look through, and I haven't had so much pleasure in finding so many things to talk about. But I think the first point that I'd like to make is that the trade, or the start of the trading session in the US today, was exactly like Friday night. You've got the durable goods orders, which were down 7.3 or 7.4% down, which is almost double the expected consensus estimates, and as a result the futures rallied. The US dollar fell a little bit, but all stock futures rose simply because worsening economy, more QE, same story, things move. All these excuses to push the market up. But as I saw over the past 5 hours, they just reverted exactly back to where they started. Nothing really exciting to report. I'm going to get some rest nice and early. But back to these articles that I found over the past few hours. A lot of them were very insightful. More or less to give you an idea as to how really clueless some of these writers or the economists are. So let's have a look. The first one that I saw was home prices across the US defy gravity despite rising rates. So home prices are on the rise. There's only one real answer to that: the Fed's buying up all the mortgages. It doesn't matter what the economy is doing. The fact that the Fed is trying to reflate a bubble that burst 5 years ago. These asset purchases are just a waste of time, because you're not allowing the free market to decide house prices. All the stimulus and all these mortgage-backed asset purchases are just propping prices up. So therefore, as I say, stimulus, all these asset purchases, total waste of time. But I suppose the Fed has one thing on its mind, and that's probably to save some time and money, I suppose, by cutting out the middlemen. Last time, the banks incurred a lot of losses by holding on to a lot of these mortgage-backed assets, and the Fed had to bail them out. Well, this time, by holding these mortgage-backed assets itself, the Fed can incur all the losses and send the taxpayer the bill straight away. So as I said, this bypasses the banks, and it saves a little bit of time when the crap hits the fan. It's crazy. The next article actually is from CNNmoney.com, and this is a really, really funny one. This article is called "How the Fed Can Taper Without Killing Housing." It was written by who gives a rat? But the two authors were economists who must have been on a lot of the wakey tobacco, because these guys reckon that the Fed can exit their quantitative easing program without killing housing. And I'm sure you've heard this before. QE won't stop, and if it stopped or is even tapered, the economy will collapse instantly. But here's what these academics are saying. They're saying, in the paper, the authors call for 3 steps. Step 1, stop buying treasuries and start selling some of the government debt accumulated over the past 4 or 5 years. The Fed currently buys 45 billion in treasuries each month, but that's not having much of an impact on the real economy. Whatever these guys are saying. If the government stops buying treasuries, yields will skyrocket. And with skyrocketing interest rates, well, first of all, the US government will default on its debt because there's no way it can pay the interest on it. Secondly, housing is just going to implode, because with rising rates, who the hell is going to borrow money for a house? I don't know what these guys are on, but as I said before, it must be a lot of marijuana or something along those lines. Anyway, we've got step 2, start selling the oldest mortgage-backed securities. The Fed currently buys 40 billion blah 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 each month in an effort to boost the housing market, but selling its older dated bonds would have very little impact on current mortgage rates, they say. You know what? That's true. The only problem is that the Fed is the only buyer of this rubbish. Who on earth would be dumb enough to buy mortgage-backed assets? Only the Fed, not because they're that smart or that dumb, it's because they've got nothing else to buy. They've bought everything. So therefore, let's have a look at the mortgage-backed assets. Next in line will be corporate bonds, but that's a story for another day. So if the Fed decides to sell, whether it be treasuries or mortgage-backed assets, this is going to collapse the market. Every market. And even contemplating selling treasuries. Now this is even before, this is a scarier thought than tapering. Because as you know, tapering is just lessening the amount of asset purchases. But selling those assets, like a full exit or a partial exit, will just collapse the system. Enough on that. Then step 3, continue buying newer mortgage-backed securities. This is the Fed's most powerful tool and most beneficial source of economic stimulus. Whatever that they say, it's just more QE. Let me tell a little bit about economists. Basically, economists are failed traders, or people who don't have the guts to put their money where their mouth is. Economists are only good at one thing, and that's dissecting and criticizing events after they've happened. When it comes to making predictions, whatever they say, the opposite's going to happen, because most of the time they're clueless. Sorry, all of the time they're clueless. So if ever you read a piece by an economist or a bunch of economists, you know that you might as well be reading the inside of a roll of a toilet paper, because you're going to get the same result. Anyway, that was a little bit of some fun there. We've got another article which talks about the 5% recovery, why most are still in recession. And this article is actually much closer to the truth than a lot of what I've read, because it's saying that only 5% of the population in the US have really recovered from this recession. The other 95% are basically living on the poverty line, and most of them because of still high unemployment. And don't forget that the employment rate of whatever it is, 7.4, 7.5%, are actually people that are actually filed for unemployment. The real unemployment would be easily double that, because that workforce has, that other half has given up looking, and they don't form part of the household survey. Another point that I've been looking at recently has been the fact that all the new jobs created, actually about 3/4 of them just this year alone, has been part-time employment. So imagine creating hundreds of thousands of jobs, but 3/4 of them are part-time jobs, and the majority of them are in not casual but hospitality jobs. So some retail, restaurants, leisure type businesses. So what's going to happen when the economy starts to regress? Well, those jobs will disappear overnight. And unfortunately, when you look at the employment factor over in the States, and you look at the situation where most of the jobs created are part-time jobs don't pay for full-time bills or full-time mortgages. Enough said on that. So just because you have a part-time job doesn't mean that you're able to look after yourself, because with rising prices, although the government would let you know that there's no inflation, everything's going up, but you're only making a part-time wage and there's no wage growth at all to support you. You're going to be living basically on a day-to-day basis, and you're going to be living basically on the poverty line. And also, to add to this, the amount of Americans living on food stamps is the highest that it's ever been. So if you believe that the economy is strong, ask that 95% how they're doing. So it's a very good article. Remember, all the articles have links that I've put in the description box. There's an article here about, it's called "A Big Risk That May Catch the Fed Off Guard." And it's been talking about the past few days how a lot of emerging markets in Asia have been suffering, and their stock markets have fallen and their currencies are falling. So what a lot of these people are doing, these governments are doing, is that they're starting to sell the US treasuries that they're holding. And what this article describes is the fact that if these countries start selling their the US debt, it means that it's, well, first of all, affecting the dollar, and secondly, it's going to send rates higher. I've been saying this for a long time. Who the hell wants to hold US debt? I don't know why the ratings agencies rate it AAA. It should be triple F, and it's not F for fail. It's F for a word that's much ruder than that. These guys selling now are at least going to get a good price for them. In due time, the longer that they hold these debt, the larger the losses they're going to incur. And the scarier thought is that the time will come where there will be no buyers. So it doesn't matter what you hold and what you think its perceived value to be, you won't be able to sell it. Look at the people who were trying to sell houses in the States once the bubble popped. Once the sellers disappear, the buyers disappear, the bottom falls out of the market. So this is not news. This is just what should be happening. When those governments are in trouble or they need money, they should be selling down this US debt. And anybody who's got any common sense should be dumping it in the first place. So that's a big hello to the Chinese policymakers. Whatever you're thinking, good luck to you. And I actually found a really funny article. The next one is called Economist ... Future Deficits Tops Fiscal Problems. And these guys are talking about what they think the biggest problems facing the US financial system is going to be. And believe it or not, these guys are talking about the biggest fiscal challenge facing the US is the size of projected deficits in the 2020s and 2030s. Why do they even bother projecting things that far when this economy is going to collapse within the next year or two, maybe 3 at the most? This debt spiral won't be allowed to go to 2020. In 2 or 3 years' time, the landscape of America and Europe will be very similar to that of war-torn Serbia, or something that's regressed 20-30 years. There's going to be a lot of poverty. There's going to be a lot of practically full unemployment. There's going to be a lot of obviously unhappiness and, as I said before, poverty. But the world will be so different, you won't recognize it. So whatever these guys are talking about, whatever crap that they're talking about, and whatever tobacco they were smoking, in even contemplating these situations, befuddles me. And actually, as I'm looking at the markets, they've suddenly taken a 180 turn, and the S&P is now down about 5 points. So there you go. You're down about 0.3% for some reason. There hasn't been any news on the news feed, and I don't know. I'll just keep an eye on it. I don't care. I'm short the market, so I'm happy. Let's just move on. Economists make me sick. Here's a good one. You've got an article on politics. I'm not going to go too deep into this one. The clock is ticking for recess and for a deficit deal. So what this article is talking about is the US needs again to have a deal done with its debt ceiling. And I always say this: debt begets more debt. And because the debt that they're incurring is non-productive, I mean, it's just going to feed consumption. So the purchase of depreciating assets like consumer goods and cars and holidays and renovations, whatever, take your money, flush it down the toilet. But the Americans love doing that, and this is going to lead to their demise. And so the government just constantly has to make the debt ceiling higher and higher, because they have to, obviously produce more bonds to pay, or I should say, in exchange for imported goods from China, Japan, whoever's dumb enough to send things to them. But this is just more of the same rhetoric that's been going for the past 5 years. In order to grow GDP, they've got to consume more, therefore they have to borrow more, blah blah blah. It's the same crap all the time. Now, there's an article here about talking about emerging markets facing an abyss. This is just something to read, but a lot of people don't think about the situation in emerging markets the way that it should be thought about. and the whole financial writing community always talk about the emerging markets as being the engine of growth for the world, because you've got very poor populations that are now joining the middle class and consumption's increasing, whatever. It's a lot of baloney. All the emerging markets are just about one thing, and that's slave wage labor workforce. If you don't have to pay people, or pay people very little to work, of course you're going to produce goods that are cheap relative to the rest of the other manufacturing countries. And as I've stated in previous videos, if you want your workforce to consume more, you got to pay them more, so you lose your advantage, your manufacturing advantage over other nations, because you got to pay them more wages. And this balancing act always becomes one of, well, we're just going to pay you more, so therefore bang, the next cheapest country is going to get your orders. You've got a problem in emerging markets of inflation, very bad inflation, and that inflation is basically caused by the Fed. When you print all these bonds and you ship them overseas, and you're basically exporting inflation. All those countries are importing the inflation that should be over in the States. So if you think that prices are rising slowly in the States, or according to the government they are, well, imagine how rapid inflation is running in these countries. And this is what's happening. I mean, India 2 weekends ago started, they've implemented price controls. This hasn't been seen in a long time in such large economies. So if it's happening in India, well, America's not too far away. Once inflation runs, it's very hard to fix. But anyway, and the other thing I'd like to mention is with emerging markets, forget their consumption. They're very reliant on orders from America and Europe. And judging from the durable goods orders in America, things aren't rosy at all. The stimulus is having less and less of an impact. So these countries, as the article says, are very prone to fall like dominoes. And they will. It's just a sad fact of life. Another really good article is from Bloomberg, and it's talking about the multiples, that is of stocks, growing faster since the dot-com bubble as the rally ages. This stock market rally came from March of 2009, when the S&P reached 666, reached an intraday low of 666. It's now trading at 1656, having touched a recent high of 1750 odd. That market has gone up 120 odd % at its peak. And as I've been saying for a long time, and I'm not going to dwell on this, the market stretched. And this is the first article that I've read, probably in quite a few weeks, that's actually saying that the market multiple is being the highest that it's been since TechWreck 13 years ago. I just shake my head when I read things like this, because it's bleeding obvious. I've been saying this, but as you know, the Fed has removed the fear factor when it comes to investing, and it's letting greed take over at basically the cost of the taxpayer. So when people have a free bet, they're just going to jump in, and if something goes wrong, the Fed's going to bail them out. What difference does it make? So this stock market is just going to keep on going as long as inflation's going to run, and the Fed is willing to support it via quantitative easing and asset purchases. But the warning signs are there, and these guys are saying that the S&P multiple is highest since tech wreck, so be careful. We've got another article from CNBC.com that says that central banks are told to cooperate on managing global liquidity. So at this Jackson Hole symposium where all these central bankers are meeting for I don't know, games of golf and a whole bunch of happy talk, the leaders are being told to sort of coordinate and cooperate on how they treat their asset purchases or quantitative easing or low rate, just basically bad loose monetary policy. And the warning comes that if they withdraw too early, things might not look so good. That's a load of rubbish. If they withdraw, the economies will collapse. Doesn't matter if it's America, Europe, wherever. So whatever that these guys say about liquidity or loose monetary policy, it's a waste of time. They know that they're stuck in there and they have to do more and more to keep this supposed growth growing, and without it, these things are gonna just disappear overnight. So it's written by the people at Jackson Hole, the central bankers. Obviously they're just to enjoy a game of golf, because all these discussions are a waste of time. And we've got an article here from CNN Money that talks about the Fed being warned of global risks to tapering. Enough said on that. They taper, everything will just revert back to just rubbish. And if they taper enough, the system's going to collapse because rates are going to rise. Let's save some time and not dwell too much on this, because it's the bleeding obvious. And then finally, you've got here an article on, I just lost it. On Bloomberg, there's an article that talks about bond yields. The bond yields show a sell-off that is beating the 2009 peaking until the rate rise. So as the US bond market suffers its worst rout since 2009, the gouge that historically signals more pain for fixed income investors is instead suggesting yields are near their peak. Yields aren't near their peak. Yields are going to go much, much higher. Well, as you know, yields, rates, it's the same thing. If the Fed tapers, then yields are going to go higher, obviously. And even if they don't, the Fed does not taper, the market has already decided and has moved to move yields higher or interest rates higher in any way. And ultimately, rates are going to go higher when the holders of all this the US debt, not speculator lemmings that jumped in buying bonds to sell back to the Fed. I'm talking like the China and Japans and the Arabs who are holding all this US debt are just going to be bewildered at basically throwing more good money after bad. They're just going to pull the plug and say, you know what, we're just going to dump this rubbish, or we're going to wipe our butts with it, because its true worth is that of basically toilet paper. Sorry, I'm insulting toilet paper. Toilet paper actually has a use. US treasuries have no use. So whatever this article says about rates nearing the tops is just fantasy. And the writer who produced this article is probably just as much on the as the article about how the Fed can exit their quantitative easing measures and still prop up the housing market. But anyway, I think I've said enough. As I said before, everything that I've spoken about, I'm going to put the links to all those articles in the description box. But the whole world, again, is hooked on stimulus. Any mention of tapering is going to send things shuddering and crashing. And when it actually happens, which it won't, it's going to be the start of the end. So the Fed can taper, but it's going to have to take that back. And in fact, it's going to have to increase its asset purchases just to keep the economies afloat. Because judging from things like durable orders and housing starts, you can see that this malaise of addiction to QE has no end. And even just the mention of tapering has led to, well, a slight pullback in the markets, but things like the rising rates is now making people not borrow money to purchase housing. Common sense. Rising rates, who wants to borrow money? Well, I think it's time to call it a day. Markets, since I started talking, have retreated a tiny bit, but it's nothing to really write home about. So until the next update or the next news insights, I wish you many happy returns and prosperous trading.